IRMAA. No, that's not a family member you forgot to invite to dinner. If you don't know what that is, you might be one of the lucky ones. If you do know what that is, odds are you might have found out about it for the first time when the notice arrived in the mail that your Medicare premiums have increased. Not a fun way to find out. For high net worth households, IRMAA might just be right around the corner. And so it's good to learn about it beforehand and what you can do to influence it so that you don't end up making those same increased payments. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a fancy way of saying an additional Medicare premium charge that increases as your income increases. Let's walk through how this works. Each year, you're enrolled in Medicare, which for most people begins at 65. Medicare will look at what your income was 2 years prior using your tax return. That means your income today is going to influence your Medicare 2 years from now. Now, the income that Medicare looks at is called Modified Adjusted Gross Income, MAGI for short. That income can include your wages if you're still working, your taxable Social Security, and yes, it can be taxable, your interest, dividends, capital gains, any distributions from your pre-tax accounts, including your RMDs, as well as any income from Roth conversions. Medicare then takes that income, whatever that amount is for the year, and it compares it to different levels of thresholds. And it says, what is going to be your premium this year based on where you fall. Now, what's different about IRMAA is it's not like our normal tax brackets. While IRMAA still increases, again, that surcharge gets higher as your income gets higher, IRMAA really only looks at where that last dollar lands. As soon as you're $1 into the next bracket, it's gonna charge you that higher Medicare premium. And that's where proactive tax planning really comes in. It's helpful to know what bracket you're in and what you might be if an event occurs. But it's particularly helpful for those who are right on that threshold, either above or below, to see what changes you can make now to prevent from moving into that higher bracket. A high IRMAA can come from a variety of reasons. For some, they just saved really diligently in pre-tax accounts. They have a high net worth, they have high income, they're living a great lifestyle, and they're just gonna hit IRMAA every single year. For others, it's more of a one-time event. Maybe you've sold a business, maybe you sold some property, or you had to realize a lot of capital gains in your account. For others, it's a house emergency and you had to pull a lot of funds from your pre-tax accounts. Others, they accidentally cause it by doing a Roth conversion without evaluating their IRMAA brackets. These can all be one-time events and something to look out for. Our rule of thumb is just know what IRMAA bracket you're in now and what IRMAA bracket you might be in if you make that change, like a Roth conversion. For others, they might have a low income year, and this isn't a chance to say, great, I don't know a ton, let's do nothing. Other times, people strategically realize income either through realizing capital gains or Roth conversions or pulling money from their pre-tax accounts. They're saying, how can I recognize more income now so I don't get pushed into those higher tax brackets and IRMAA brackets later? The goal is not to owe nothing in taxes or nothing in Medicare surcharges, although that would be amazing. The goal is to say, how can we reduce our lifetime taxes and our lifetime Medicare costs using strategic tax planning? The key to IRMAA is just coordination. Coordinating your investments, your income, your Medicare premiums, and everything else in life, and incorporating it all into a comprehensive plan. That's something that we like to do here at PY Walton. Instead of just looking at each of those elements in isolation, we bring it all together and help you see how they all fit and what decisions you can make today to influence that future. Because it all comes down to, how does this impact your life? Our goal is to help you keep more dollars in your pocket so you can do the things that you want to do in retirement.